All right, everyone, welcome back to another weekly Roundup edition of On the Margin. Today, I'm joined, as always, by my curious co-host, Mr. Mark Yusko. Mark, welcome back.
Curious. I like it. Man, it has been a day. So we're getting started a little bit late. So started this week with, I get a cold, Joy's grandkids. My son last night says to me, "Dad, you look 10 years older. You're so white, you're so pale." And I'm like, thanks, son. So then I wake up this morning and the internet's out. So I got to scramble to get ready to come to the office so we could do this. And I get here and I realized that he had taken my credit card last night to buy some video game, and I don't have my pass to get in the office. So we get in I guess we have some remote thing. They let me in. And then the other part of it is I had a little domestic accident last night, and it turns out I only have character Band-Aids. That's the joys of having grandkids. All right, so we'll do the quick reveal. So yes, I'm wearing the Bitcoin orange pants, and then I have the Bitcoin Bull Cape Crusader socks on today.
I love it.
So, bull market, fully engaged. Crypto spring is here. We'll talk about lots of stuff. But anyway, that's all my ranting.
The joys of parent. I've got a friend whose older brother is he's got 2 kids already, and he's got a third one on the way. And he was just kind of telling me all the different ways that his life has changed. And in society, we do, rightfully so, right? We do a lot of like celebrating of kids. I think there should be more celebrating of parents, because my God,
yes.
It is a heroic feat. Mom and Dad, if you're listening, thank you very much.
There's no training. There's no manual. There's no certification. It is making it up as you go along. The fact that any of us as parents survive is, I agree with you. We should
shocking.
Celebrate parents.
And then what's the reward? It's like you got to deal with a tiny little person with attitude, with hopes that by the time they're like 25, they'll recognize all the good stuff you did. Parents out there, there should be a Parents' Day, is what I'm saying.
Yeah.
Let's get right into it, though. I use the word curious, the adjective curious here for a reason, because I've got some questions for you. Basically, there's a lot of stuff going on out there that I don't really understand, and I'm gonna kind of I have some ideas, but I want to get your opinion. So, basically, I want to start by kind of talking about GDP. So what we're looking at here is contribution to real GDP by sector, right? So real GDP, obviously, kind of adjusting for inflation. And it's what's sort of curious to me in general. I think that the GDP chart is good to look at because it sort of frames this question that I'm having for myself, which is just where are we in the cycle right now? Because everything about last year and this huge change in stance that the Fed has, I kind of had an idea of what was going to happen, and some of that happened, but a lot of it hasn't. And maybe it just hasn't happened yet. But, we kind of had this enormous contractions in terms of the monetary environment. And some of those effects, we knew that there was going to be a lag in between the transmission, right, from when monetary, tightening started and when some of these effects were going to be felt in the real economy. But, we are about a year and change later, and GDP is the same as it was in Q3 of 2021, right? Around when the tightening sort of started. So I'd love to get your thoughts here on this GDP chart, and then we can maybe talk a little bit about just where you think we are, because it looks like risk assets and stocks are getting a bit of a bounce. Crypto is doing better, and it seems like we kind of still have these overhangs, but the further we go without another shoe dropping, I do find myself questioning, like, was I sort of wrong here about my perspective that there's more pain to come? Like, is there a possibility of a soft landing? Or that was a whole big lead up to this. But what do you think, Mark?
No, look, I think it's an important point, and we talked a little bit about this a few months ago when the Q3 number came out, and everybody was celebrating because it was this big number after the 2 negative quarters, and which was not a recession, right? Not a recession.
Not according to the White House, no.
Well, right, not according to the White House, but the bottom line is Q3 and Q4 GDP numbers are, how should we say this, more bad than normal. I mean, all numbers are bad, right? And I don't mean bad like evil. I just mean, imagine trying to count the productivity and output of 330 million people every 90 days. I mean, it's probably you're going to use a lot of estimations. You're going to, and getting it exactly right never going to happen. But Q3 and Q4, a big chunk of the quote unquote GDP growth was simply the release of the SPR, and you see that in the government spending. So I guess 3/4 or 70% ish of this GDP number is government spending and inventories. And inventories is the other thing that is kind of comical, in that building of inventories is not good. It means that
Yeah.
people aren't buying stuff. But we count it, and we have all these funky rules for how we do GDP. Like we don't count the negative effect of a hurricane, but we count the rebuilding. That doesn't make much sense. So bottom line is the numbers are what they are, and as long as they're consistently mediocre, that's okay. Um, I'm with you. I had the same kind of reaction, and I did my 10 surprises yesterday, which is kind of a fun exercise, in that what a surprise is a position that's antithetical to consensus. That
Yeah.
if it happens, you can make a bunch of money as an investor.
Mm.
So, you have to one come up with consensus. So what's consensus? Then you have to come up with an idea that's anti-consensus, and that becomes the surprise. And I've been doing this for, I don't know, 10 years or something. Byron Ween's done it for like 30 years. And it's a fun exercise because it makes you go down these rabbit holes. And on GDP, I would have been in the camp that after the bad Q1, Q2, we were going to have tough Q3, Q4. Now, it's funny. I actually had one of my surprises a year ago, being that uh, the White House would go after the price of oil. Because remember, oil spiked to 125 bucks in March
Yeah.
of
Yeah.
last year, and everybody's like, "Oh, it's going 200 or 300." I'm like, "No way, y'all! This is an election year. There's no
Hmm.
a midterm election. There's no way they're letting gasoline prices go to 5, 6 bucks."
Hmm.
So, uh, but I didn't think they'd tap. And what I wrote was either OPEC is going to pump more, right? They're going to go over and beg their partners to pump, or they're going to have to tap the SPR. But I didn't then go further with that and say, okay, well, if they tap the SPR, then Q3, Q4 GDP will rise, because I'm just not really that facile with that part of calculation.
Yeah.
So that's a long way of saying uh, I think Q3, Q4 are anomalous. I think Q1 is going to be negative. I think it's going to be materially negative. So all this soft landing stuff is going to go away. Now that they'll explain away as seasonality, and I love this part. So they seasonally adjust all the numbers.
Hmm.
Yet first quarter always seems to be really tough. Like, well, but if you seasonally adjust, why don't you seasonally adjust all the way?
Hmm.
Um, but my last thing on GDP is I've been saying for a long time that we are in kind of the 2000 to 2002 redo, and that last year was 2001. 2001, amazingly, first quarter was negative GDP, second quarter was positive, third quarter was negative, exacerbated by 9/11, and fourth quarter was positive. The whole year, 1%, and it was a recession.
Yeah.
Okay.
Yeah.
Called after the end of the year, right? So they called it backwards. Last year, first and second quarter negative, third and fourth quarter positive, full year, 1%. 1%
Mm.
is a recession, full stop. Anything sub 1.5% is a recession. Always has
Mm.
been, always will be. But they're not going to call it a recession because they're jiggering the uh, unemployment numbers with labor force participation rate, et cetera. So no, NBER, right, is in handcuffs. They can't call a recession, even though every definition of a recession is. And recession doesn't mean calamity, but
Yeah.
1% GDP growth is a recession.
Yeah. And for folks who aren't following along via video, you just to share some numbers of the charts that we're looking at. So the expectation was that real GDP was going to come in 2.6%. It's come in at 2.9%. So it's over the economist consensus or whatever. It was interesting to sort of, like you and I were talking about, the bullwhip effect, right? That Michael Burry was talking about for a while. And you can actually see that in the inventory prints, right? It's that yellow line on the chart on the right. And we built up inventories to your point, right? Which can be good if you move those inventories, but if you build up inventory in excess of demand, then you're going to have to write those inventories down eventually. So you kind of saw that drag a couple quarters later, but now we're back to being positive, which I guess could be interpreted as a bullish
Yeah,
sign.
could be.
Um, Here are two more parts of GDP just before we move on, and then we're going to show some charts kind of digging into U.S. households and their financial situation. But on the left here, we've got real final sales to private domestic consumers. That's kind of core GDP, right? Like really, at the end of the day, the U.S. consumer is the engine of growth, right? So
Yep.
it's interesting to track, right? Like what real final sales look like, and that's pretty low, right? And then on the right here, we're looking at housing investment and that contribution to GDP. So you saw this enormous, it was huge tailwinds over kind of the 2020 period, and now that's collapsed and it's been a consistent drag. So I mean, these were just two sort of bullet points I pulled out here. I'm not sure if anything stands out or if
Yep.
you want to just move on.
The American economy, U.S. economy, is 72 ish. Pick a
Mm,
number, in the low 70s percent consumption. So the fact that the consumer is struggling is a big deal, right? And this idea that somehow everything's going to be okay, I don't know. I mean, part of the problem I have with, again, it's the data, retail sales. So retail sales have two problems. One, they don't adjust for population growth, which is
mm,
absolute insanity. And who made that decision? I don't know. But the idea that you just put up a number and don't say, well, there are more people, that just it makes no sense. And
mm.
the second thing is they don't really. I mean, you get real numbers, but they don't on the nominal stuff. There's no construct for adjusting for the fact that, like, if gasoline prices went up really high, people are buying more, but it's the total dollar amount. It might not be that they're buying
Right.
more and more frequently. It's just that the prices rose. And so, one of the things that I said could be a big surprise this year is, as inflation ebbs, which I think will be in deflation by the end of the year, uh, that tailwind for corporate profits, right? Because prices are higher, et cetera, will dissipate. The second piece here on housing, this is big, right? The housing collapse is 35-40% of the way through. It's just getting warmed up. I mean, I'm going through it literally in that, uh, and it's less of an impact for me because I'm not moving. But 10 years ago, I picked a mortgage, and I didn't even remember this, but I picked a 10-year ARM, and I just got a little nasty gram in the mail saying, "Oh, guess what? In 2 months, your interest rate's going to go from 3 to 6." Like, huh? Yeah, I probably should have been watching that. Um, I don't even remember picking that. I don't have any recollection. I've always had a fixed rate mortgage, but for some reason I picked a 10-year ARM, probably thinking that I'd be done with the mortgage by then because I've been in the house a long time. But whatever. Um, so now the question is, do I pay
Re-
down the mortgage because it's not there's not that much left because I've been around been in the house a long time. But anyway, that's happening to the real a family that is going from 3% to 6%, young family with kids, you got to come up with $1,000 a month. No way. No way. So
yeah.
that housing prices, I think, are going to fall a lot. And that's going to be a big drag on GDP.
There's sort of like single family, like residential real estate, but I also took a lot away from that conversation that we had with James last week about uh, you know the big institutional buyers of real estate, like the Blackstones
Yep.
of the world, right? And kind of my takeaway as someone who's not an investor or an expert in investing in real estate, right, was basically that cap rate to interest rate ratio is something that's very important. And when you have record low interest rates for a while and an industry that's dependent on acquiring assets, right, that are very levered to the price
Yep.
of interest rates, you got a whole swath of probably the institutional part of the real estate market, which is underwater, and they're seeking short term financing. I mean, that's another thing. I mean, people, there was a people still say this, right? The thing that kind of brought us down in the great financial crisis. So the first thing to kind of turn were those ARMs, those adjustable rate mechanism, very short term, very variable mortgages, and now we've got all these fixed rate mortgages. Well, that doesn't magically make bad investments good investments, right? It just means that you delay the outcome for a
Right.
little while as well.
Right.
So that's something to consider.
Well, to your
But
point on
uh,
refinancing, it's not just mortgages, right? Um, 70% of corporate debt is less than 1 year. So
mm,
all of these companies that borrowed cheap are going to have to refinance that debt at significantly higher prices. That is going to chip in. That's going to eat into margins pretty badly.
yeah, and this, just to put a bow on everything that we're saying. This is real GDP, over the Goldman U.S. Financial Index, conditions. This is a measure of, Goldman's measure of the tightness of financial conditions. And again, the point obviously is going back to 1995, and you can see that those two things are very correlated. Financial conditions have plummeted, and real GDP for the U.S. is starting to follow, but it hasn't it hasn't gone all the way there yet. So there are a lot of charts like this, and sometimes they end up playing out, and sometimes they don't. But again, just something to consider.
Well, but you
I
look
have,
at this chart. Go back to that chart for a second.
yeah,
Look at that chart. Okay, so the gold line is the financial conditions inverted, and then the black line is GDP.
mm,
There are no situations, right? Precisely zero, where the gold line, right, financial conditions worsen, meaning the gold line goes down, and the black line goes up.
yeah,
Zero. So
yeah,
this idea that somehow it's going to diverge, it's just not. Now, it doesn't have to go all the way, right? I
right,
mean, you can see in 2009 that financial conditions got, to -10, uh, and, GDP only
only right, yeah,
fell, 4 or 5%. Um, so that's definitely possible that, that black line that's up there at 2.5% positive, I'm sorry, 1% positive, trailing 1 year, um, you know, gets down to minus 2.5, 3,
hmm
4. That's an ugly number. Now, could it go all the way down like it did in 2020? No. I mean, we're not going to, well, I hope we're not going to lock down everything. I don't think we're going to lock down everything. But I, I said, I think first quarter GDP will be negative. How negative? Don't really know, but that's just my view.
yeah. I want to. I'm with you on that. It's a good call out. I mean, rarely, right? Actually, does the black line trail the get as bad. You have it doesn't have as marked swings, right, as the financial conditions, because that's what the Fed is trying to correct for that black
Yeah.
line. But
Yeah.
um, all right, I want to get to this is I've got a bunch of slides here on sort of taking a look at the financial condition of U.S. households, right? And this is, we're starting with housing here because that's a huge part of it, and there are just a couple of different charts and ways that we can look at this. But you know what? I want to skip ahead, and I want to show you something here, which is I found pretty surprising, and this might actually set us up for the rest of the conversation. So we're kind of sitting here saying, yeah, I mean, we'll see what GDP ends up doing over the next couple of quarters, but I mean, this chart here, these two charts about, sort of the financial situation of households, this is very indicative to me of why there might be kind of this levitation in the economy where you would expect more carnage. So on the left here, we're looking at household checkable deposits. Basically, this is just the cash that households have on hand, and you can just see there's there's kind of small, at the bottom of the chart, uh, baseline, right? And then there's what's actually happened since 2020. And I mean, the cash that households have on hand has, more than doubled in the last 2 years. And then you kind of see it broken out by income on the chart on the right. But it's basically saying the same thing, which is just that households are just sitting on a lot of cash right now. And maybe that's the reason why all of this stuff is held up. And some of it comes from kind of transfer payments, right? And support from the government, like fiscal support from the government. But a lot of it is also, I mean, people have been worried about a recession for such a long time that people have also, people are also kind of hanging on to the cash in their accounts. So I don't, what do you think about looking at anything kind of jump out at you at these charts, Mark, or what
So
do you think?
I think it's a really good one because uh, if you think about the charts that are making the rounds, on Twitter and elsewhere, it shows the absolute collapse in say U.S. savings rate, right? I
Right.
mean, it's just absolutely collapsed, and then credit card delinquencies have gone absolutely parabolic, and
Hmm.
credit card usage has gone absolutely parabolic, and credit card delinquencies have ticked up. And everybody's like, see, the consumer's up, but there was a great chart that did what you did, which is said, well, hold on. You got to overlay the fact that the government wrote these stimmy checks in 2020, and a whole bunch of people have quote unquote excess savings. And I think this chart on the left is really important, which is um, you can see the gold, which is the fiscal support. So at the lowest end, there's a meaningful amount of money, right? If the government gives you $1,200 and you don't make that much money, it's a meaningful amount of money. At the top, yeah, whatever. I mean,
Hmm.
people who are super wealthy, that $1,200 really didn't move the needle. But then the green, which is the reduction in outlays, you can see the average family has tightened their belt. The top quartile, not so much. They're just blowing and going, but they got plenty of money. So, um, and you can see that right in the high end stuff. Louis Vuitton and Richemont
Yeah.
and those things have held up quite nicely. Um, so I think where we are on this is that pool of capital. Um, it's real, but it's not permanent. And while there's a lot
Right.
of talk about things like UBI, they're trying to bring that back up and say, oh, we're going to do this consumption tax and we're going to tax the rich and give to the poor. Okay, maybe. Um, but in lieu of that, uh, the fact that people are having to use credit, use credit cards, is has never been a good sign for economic growth.
Yeah. Well, I mean, we were talking about this. I mean, I guess I'm just registering a little bit of confusion because there's a lot of way to slice, the health of households and the American consumer, right? And when you do look at excess rate, the savings rate plummeting and the credit use of credit cards, skyrocketing. I mean, that should cause anyone to have some concern. But then there's just a whole other dimension of just to kind of look at the amount of cash that's been built up over the years. So I guess I'm sort of saying I'm a little bit confused to look at all of this different data. But I mean, to me,
Really?
actually, a more resilient consumer would help explain a lot of the stuff that we're seeing. Actually, the results that we're seeing in the economy, because earnings have held up and GDP has held up honestly much better than at
Yeah.
least I
I
thought
mean,
going into these last
earnings
two
were
quarters.
okay, right?
Hmm.
Q4 earnings were okay, not awesome, but okay to that point.
Hmm.
I think it's coming, right? I think the December retail sales number, down 1.5%,
Hmm.
was one of the largest drops in at least 2 decades. Might be longer, but it was a big number. Uh, and you've seen a couple misses on earnings that have been material.
Yeah.
Um, so look, I do think for the bulk of this year, last year, 2022, people were able to dip into that cash reserve. I think much of that cash reserve is used up. Not all of it, but much of
Mm.
it, and it's going to be tougher. But we'll see. I mean, I will say that you know I'm not traveling as much as I used to, but when I do travel, airports are pretty full.
They're
Flights are still
packed.
pretty full. In fact, I think I saw a data point that TSA travelers just exceeded the pre-pandemic level for the first time.
Yeah.
So, that's a positive.
Yeah. Yeah. Another thing that we've talked about on this show that I think is just appropriate to maybe direct a little bit of nuance and attention towards is the layoffs that have come from big tech. And, media loves news of layoffs, right? Because it's a dramatic thing, and you can throw some like big number, quote unquote, out there, and it seems like this dramatic sort of event. But just to put in context, Google they announced they laid off 12,000 people or something. It's like
Yep.
12,000 people. And I have friends who work at Google. Everyone's like very shaken up about this, and people are worried. But it's like, guys, that's you have 160,000 workforce, a global workforce, right? This is about 6% of the
Yeah.
workforce that got laid off. And even more importantly, it's like since I think 2021, they've hired 30,000 people. So you have laid off, you're still a ways away from even the pre-COVID, sort of level. I think I saw there was some activist shareholder that wrote a letter which is saying, hey, we'd like another 20% cut to get you to where you were just around, pre-COVID, basically.
Yeah,
So
and look, I'm sure you've seen the TikTok uh, of the woman who did the before and after. She did a TikTok of day in
mm,
life at Google. Oh, you got to see this.
yeah.
So she did a day in the life at Google, and then she did a day, and then she said, "Oh, and I just got laid off."
Mm,
So, but the day in the life, I, I, it was it was so gross. I mean, oh, I come in at 9 o'clock and I go get, some free food out of the pantry and then, I go to one of our beautiful conference rooms and I take a meeting and and then like by fourth and then she got a massage and then she was like done by 4:30. I'm like, That's not like high productivity. There's not a lot of there. So maybe it was not the average, person there. But I was like, if that's what we're paying for, yeah, some cutting of that fluff, not a bad thing. I will say, I think I told the story one time. So I got asked to speak. It was funny at the Google Investment Club.
oh,
So
really?
Google has this
Yeah.
investment club, and they're value investors, right? Because
Mm,
all their money is made by growth, and so they'd had Charlie Munger, and I'm like, I really don't want to talk to a group that's had Charlie Munger come in. So, um, but I did it, and they're taking me around, and we go to one of these fancy restaurants, and I said to the guy, I said, so how many people are on the campus? And he said, oh, 25,000. And his friend goes, oh, dude, there's at least 40,000. I'm like, so within 15,000, you know how many people are on the main campus.
mm,
So that's how crazy that hiring. I found that just amazing. It's 25 or 40.
mhm. I mean, and you know what? It's just there's nothing bad, right, with like people who do good work and they, you want to see salaries rising. And there was a lot of flack. The median salary at Google was $300,000, and it's like I know that's a high number, but like it really depends on what Google is getting in return for
Yeah.
that labor, right? I mean, Google's like the best money making machine of all time. But I agree, there's definitely been a little bit of excess. But the overall point is just that again, tech is very visible, right? And I think those TikToks, of like the day in the life of the product manager, like captured the zeitgeist a little bit because people hate seeing that, right? I mean,
Oh no,
it's like
it's brutal.
it's a
It
hateable
made
thing
me
to
it made
watch.
me angry. It made me
Yeah,
physically angry.
it makes people angry, but ultimately, like it's such a small percentage of the population that
I
it's
know.
much
I
it's
know.
much smaller than like the broader economy is like is not that, right?
I know. And look, we have a Google office here, and those guys are not doing that. They're doing venture stuff. And
Mm,
but I think the bigger problem for big tech, it's not the costs, it's the lack of revenue growth.
yeah.
And I've done a bunch of stuff on this that if you look at, FANG, Facebook, Amazon, and really I'd probably put FAMGA, so Microsoft, Google,
Microsoft should be in there for sure. Yeah.
because those are the big ones. So it's not as good a acronym, but FAMGA. Those four big companies, if you look at their revenue growth, 40, 30, 20, 10, 5, 3, 1. I mean, Microsoft, the reason Microsoft, went down the other day is they reported 1%, 1.4% revenue growth. Apple is down sub 1%. So these are not growth stocks. I mean, you look at Apple's EV to EBITDA. I mean, it's orders of magnitude beyond where it should be for a company that's growing 1%.
Mm.
And it's because they are cult stocks in the sense that they are such a big piece of the index now that everybody's 401k who buys a S&P 500 index fund has to buy 7% of Apple and 4% of Microsoft. And I don't know. I made a bet, not a bet, challenge with Kevin O'Leary on CNBC 4 years ago that Amazon would be dead money for 10 years. He's like, "Oh, you're an idiot. That could never happen." 4 years in, dead money. It's actually down.
Mm.
And I'm pretty confident that I'm going to be right, because it's not that it's not a great company. It is a great company. But the
Yeah.
valuation got so crazy that it can't survive.
Yeah.
Price can't survive.
What's going on, guys? Want to give a quick shout out to this episode's sponsor, Curve. They are the one-stop shop credit cards that helps you take control of your personal finances. Here's the reason that I personally love this company. These guys are all about helping you manage and maximize your personal cash flow. We have been talking for the last couple months about everything that the Fed is doing with raising interest rates. Obviously, this is no one's got a crystal ball. This is not financial advice, but I think it makes sense more than ever now for companies to be managing their cash flow and for you as an individual to be managing your personal cash flow as well. Curve makes it super, super easy to do that. Even I can do it as a technological Philistine. They aggregate all of your spending information in one place. They make it super easy to plan. But they actually go one step further than that. They have a very cool feature called Go Back in Time, which allows you to switch payments from one card to another. So if you have an unexpected expense crop up, boom, you can move that over to your credit card, free up some cash. Or maybe you learned too late that you could have earned more rewards by spending on a different card. Boom, Curve has you covered there too. And the last thing that I'll say is, if you click the link at the bottom of this episode, you'll get $20 in Curve cash, but you'll only get that if you click the vanity link at the bottom of this episode. Plus, that gives me the credit as well. So thank you, Curve. I appreciate you caring about cash flow. Guys, click the link at the bottom of this episode. Tell them I sent you. You know what else is funny? I mean, I think the more telling, the more important data point that people have talked about but aren't really talking about is the actual high level sort of CEO, founder, exec level departures that have been happening at some of these tech companies.
Yep.
So in that FANG acronym, in the last couple of years, since you made that bet, after you made the bet with Kevin, we've had Bezos depart.
Yep.
I don't know if you just saw within the last week or two, Reid Hoffman,
Yep.
the founder of Netflix, departed.
Yep.
And people always say, and we had Sheryl Sandberg and some of the executives at Meta, depart. And I don't know, we just watched a wave of departures in crypto. And there's that very famous tweet now, which is, who is the guy at Tabasco, Sam Trabucco at Alameda. And, he tweets this thing, why do journalists want to make a big deal out of me leaving when I just want to make my boat go fast over the water? It's like, oh boy, has that not aged well.
Woo.
And it's kind of like, these guys and everyone, of course, they want to paint it as, look, I've built something here. I just want to take time with my kids and my family. And well, you weren't saying that when the stock was going straight up, is all I'm saying.
Absolutely. Look, we are definitely witnessing a sea change, but this is the way evolution works.
Yeah.
And this is not new, right? I mean, the biggest companies in the stock indices were other things. They weren't always the FANGs.
Yeah.
There was a time when it was the telephone companies. There was a time when it was the steel companies. And that's why I think so many of us have now shifted into Web3 and the next iteration. Web 1 was amazing. It was amazing. I mean, think about we were talking about this. So I woke up this morning and my internet is down. So I got to scramble. I can't stay at my house because I got to do this and I need the internet. And you said, and I love this, said, the internet went down the other day and I'm sitting here, I'm like, well, what do I do? There's nothing I could do. Like, what? What? The mind
Yeah.
just blows. But it's true. I remember we had an ice storm down here a number of years ago, and power went down, and therefore the internet's down. And I'm looking around the office, going, "Oh my god, I can't get to anything. Like I physically can't get to the phone numbers of people to old school call them. I can't get to my report to work on because it's in the computer. And if I don't have electricity, I'm dead." So look, the internet is amazing, and we use it every single moment of every day, right? Great. Web 2, all right. Social media, not really a fan, actually,
No.
right? I'm not. And I I look at what it does to, the kind of self-worth, particularly of young women. It's not good. It's just not good. And yet, look, when Twitter was talking about going down, I was freaking out. I was freaking out because I'm like,
Yeah.
whoa, where would I get my news? Where would I get my friends? Because
Uh-huh.
all my friends I have met, like I was talking to a guy yesterday. I did a podcast. I shouldn't say friends, but acquaintances.
Mm.
I mean, we did a podcast. He's in Australia. Like, and we become friendly halfway around the world because of the internet and because of Twitter. Like I never would have met him in the old days, right? I wouldn't have got a pen pal letter just randomly. So I I think as much as I like to, yell at social media, I it does have some benefits and some advantages. I will say the one thing. I don't know if you saw the thread. I retweeted it from this guy who went and spent time with Elon to try to understand this whole shadow banning thing.
Mm-mm.
And I'm gonna give Elon some props here. I'm not the biggest Elon fan, but I'm gonna give him some props that he let this guy go in and talk to the engineers and find out exactly why his account had been shadow banned. And actually admitted that, yeah, this is a problem, like a real problem. And the guy had 3 bans. He had a misinformation ban, and 2 others. It's in the thread. Um, and look, I know I'm there. I mean, I've had, what do it doesn't matter. I've had 139,800 followers for 3 months, like, precisely.
Yeah.
And I'll get a notice that, "Oh, you got 10 new followers," and then I'll look at the number, and it'll be exact same thing, 831, 833, 827. Clearly, I did something to somebody, said something, liked something, commented on something, retweeted something, and I've now been labeled a misinformationist or whatever. But, I didn't go all the way to get, like, completely banned. But anyway.
This is sort of I mean, everything that we're talking about is the natural evolution of what happens to different industries, right? I mean, it starts as this, in a lot of ways, like, I mean, if you go back to look at some of the early things that people were saying about tech, there's so much to understand and love about that. And it really rhymes with crypto today. I mean, a lot of the people in the early web were, not ideologues, but they're very optimistic and had an idea
Yeah.
about what they want to build. In some ways they built that, in other ways that their narrative really fell down, and I think a lot of the idealists sort of got kind of had their dreams.
Well, it's all to your point, it's the ideologues or the ideation people that build,
Right.
but then it's the capitalists that come in
That
and
come in
exploit.
and right.
And look, my life is better because of Web 1 and Web 2.
Yeah.
Full stop. And
Yeah.
my life is gonna be better because of Web 3. Full stop. Decentralization. And I think we talked about this. I had this little, mini existential crisis. Um, but I read, Dar Albright's blog post over the holidays about decentralization, and it really snapped me back to reality. And I think everyone needs to read it. In that, it just the inevitability of decentralization, the inevitability of more robust systems, the inevitability of being able to transfer value, you know, straight without
Mm.
intermediaries, it's all there. It's all, and our lives will be enhanced. Now, are there going to be grifters? Are there going to be scammers? Are there going to be bad people? Of course. But go back to the internet. Tons of grifters, tons of scammers. I mean, the original ISP, internet service providers, like when it was a bunch of guys with, computers in their basement, tons of bad stuff where they were, phishing your credit card number and, you know, buying all kinds of crazy stuff. So it's not a surprise that bad things happen in crypto. What's surprising is that we act like it's new. It's just not, right? You go
Yeah.
back to any technological innovation, railroads. There are plenty of grifters around railroads. There are grifters around, air travel. I mean, anything.
It's it's 100%. All these questions about the shadow banning that happens on Twitter. The point I was, sort of trying to make is that, these industries, they start as one thing, they become another. We're seeing the shift from like high growth industries to like cash cow type
Yeah,
industries. The next thing is like regulation, and then they end up looking like just any other industry. And then
yeah,
there's a new
like
industry,
utility.
which is yeah. So I'm a little bit torn, and I've always considered myself like in the not. I don't really believe that Elon Musk is in the total free speech camp, but like I would put myself as like I think that's important, right? I think he's doing it kind of as like a branding exercise, but I
Yes.
believe in it. But I'm sort of torn. I heard on all on podcast. I'm blank. Jared Friedberg had a great argument for. He was talking about what his sort of conception of like the Twitter files, which was to me, I think is my favorite take that I've heard about it, which is Twitter is trying to build an editorial product. So is Google. So are all these sites. And the reason is like everyone says, I don't want that. I don't want your editorial opinions. I just want all the information until you
Yeah.
get all the information. And then it's confusing. It's annoying. It doesn't feel like, you know, just organized in a way that's, attractive to you at all. So then someone has to come in and say, okay, look, this isn't what the customer wants. So we got to give the customer more of what they want. So I do think it's appropriate to like look at Google, even like these aggregators like Google and Twitter's, they're creating an editorial product for you.
Oh,
And,
100%. I mean,
you know,
I go
so
back and
I don't
forth,
know. I
and
struggle
it
with it.
used to be the little 3 stars in the right hand where you could
Mhm.
flip between the algo and those that you follow. And everybody's like, "I don't want the algo. I don't want the algo. I don't, I want the people." But here's the thing. I go back and forth, and now it's right on your front page, right? It's for you and, who you follow. Here's the problem. In a perfect world, I don't want the algo, right? As smart as it is, as good as it is, I don't want the algo. I want my carefully curated group of people that I have put together. I want the information. But here's the problem. You have to constantly curate or it degrades like really fast. Like if you like, friend from high school, perfectly fine. I mean, follow a friend from high school, perfectly fine. But then it turns out they're clogging up your stream with stuff that you don't necessarily want.
Yeah.
And you really, you want to talk to them and you want to communicate with them and you want to be able to DM them, but I don't really want to follow them. Or something changes or somebody changes jobs. And so I, now have thousands of people that I follow that I probably should unfollow, but I always feel guilty if I unfollow somebody because I feel like they're going to get and so the curate, unless you're really active in curating lists and it's not as useful and it's filled with stuff that you don't want to see, where in theory the algo can do this editorial function and say, okay, based on your preferences, this is what you want to see. So I go back and forth and but then what'll happen is this nonsense of, well, then somebody inside Twitter with an agenda starts putting stuff in that I don't want to see, right? I get these weird things now. I mean, totally nothing to do with anything I've ever followed, and it's either a political thing or a gender thing. And I'm like, stop! I don't want that.
Mm.
And then I'll go back to the curation, and then I'll get tired of sifting through, the high school friend stuff that I don't want to see. And so it is a tough one. And the best analogy I can use is Pandora, right? Pandora. You type in, okay, I want to listen to Bruce Springsteen. Okay. So I get the Bruce Springsteen channel and I hear The Boss, Born in the USA. But then the next three songs are not from The Boss. They're from people the algo thinks I might like based on what other people like.
Mm.
And it's awesome. It's
Spotify
awesome.
algorithm is probably my favorite algorithm that I've
Okay.
ever interacted
Yeah.
with. Yeah,
And
it's
I
phenomenal.
think, I'm old, right? And I invested in Pandora, so I'm a Pandora guy. I'm not a Spotify guy. And that's not good or bad. But it's amazing. I have this one that my son, I have the 12-year-old and he has different music taste than I do. So he gave me, I can't remember, it was like Macklemore or something like that. And I can't remember, I mean, it was something like that. And but here's the crazy thing. I've discovered a bunch of music that I actually like
Yeah.
from that algo that I never ever would have looked at.
We gotta get you on the Spotify algorithm, Mark. It's life changing. I'm telling you. It's
All
I
right.
don't want to. I'm rooting for you and your Pandora investment. But we gotta get you on Spotify as
Look,
well.
I'm out. I sold the Pandora a long time ago. So all
All
right,
right.
I'll try the Spotify. But my point is, I I'm okay if the algos are doing what the Amazon algo does,
Yeah.
right? And maybe the Amazon algo is bad too, and I just don't know it. But I feel like the Amazon algo actually suggests things to me based on my buying patterns. I don't feel like it's pushing a political agenda. And I can't say that about Twitter. I think Twitter, unfortunately, does because, and that's true of all media, right? All media
Yeah.
has a reputation of being left or right.
Yeah.
And maybe it's true, maybe it's not. It's probably a little bit true, or not everybody would believe it, right?
I've got one sort of note. Actually, I was just remembering this before we. I want to just sort of close with us just talking about like crypto and some of the price action that's happening in crypto and get your thoughts on it. But there was this just while we're talking about big tech here. I think we've shifted from crypto being the bubble to AI. Kind of a mini bubble being driven by the success of Chat GBT and OpenAI, which people are really excited about. Did you see the reaction to so BuzzFeed announced that they were going to start using Chat GBT, as a and look at this is what happened to their stock price. I don't know if you saw this, like right after they announced the stock, not some crazy
Yeah.
amount, but the
Yeah.
stock.
Yeah. Yeah.
Oh yeah, I guess it was up, almost 90%. Yeah, that's a ridiculous. That's
Look, I
ridiculous.
mean, it is ridiculous, and it's literally like, I'm gonna change my name to .com, and or Riot goes the other way. I'm gonna take the word, blockchain out of my name. Look, Chat GPT, it's great. Is it the greatest thing in the world? No. Um, is it gonna have super huge problems scaling? Yep. Does it make lots of errors? Yep. Is it going to get clogged when a lot of people are trying to use the same thing and it anyway? But yeah, that's crazy. But it wasn't Macklemore. It was Marshmallow and Bastille. Those were the two.
All right.
Marshmallow and Bastille.
Um, I've got so the Chat GPT thing. I think so that stock that was the market thinking. There's partly that's just like the algos and hype and whatever. But I think, the rational explanation of that was the market thinks ChatGPT is ready to replace reporters, right? And I think the market is wrong there. I think what ends up happening is ChatGPT ends up being like a super powered kind of spell checker. But it's more of like have you ever used Grammarly or something like that to
Yeah,
check your spelling?
yeah,
I think ChatGPT will be something like that, but a more powerful version of that, where it helps you do filler paragraphs. Like if you've ever been a writer and you're kind of trying to remember like
yep,
what to write, so it is really good at generating these like generic kind of outline and like paragraph blocks describing things that
sure.
help you move faster as a reporter and a writer. And kind of helps you just like keep the ball moving and stop writer's block. So I think it will be a powerful tool but it's not. Investors are being like, oh, it's going to replace report, and I just think that's
No way.
completely
I'm with you. I mean, look, it's loquacious to the point of arrogance. Like a lot of the stuff it spits out is just it's not even fun to read. It's
Yeah.
so, hoity-toity. Um, and I said it's full of errors because all it's doing is pulling from reams of data. But here's the other problem it has, because we've already seen it. It's scrubbing data that now people are saying, "Well, that's my data. That's not your data. You don't get to
Right.
scrub that. You don't get to use that." So as those walled gardens go up, the efficiency goes down, the effectiveness goes down. And to your point, here's the thing, and I believe this 100%, and maybe I'm wrong, but I don't believe AI, and I'll say it, I don't think it'll ever get to where the human brain, like we probably had an idea of what we were going to talk about today.
Hmm.
But that's not the way the human brain works. My brain is messed up. I mean, it goes in all different areas, and I don't, and these numbers can be off, but directionally they're saying. Someone was saying that every day, you get like 11 million pieces of information. Like your brain has like 11 million, and you deal with like 17. And those numbers aren't exactly right, but proportionally they are.
Hmm.
And so I marvel, right, at how a conversation ebbs and flows and how the human brain makes linkages. No chance ChatGPT is going to do
I
it.
I'm
0
I'm
chance.
wi- I'm with you, but I would just say like people sometimes have this idea like, oh, AI is never going to get to human. We have a very specific type of intelligence, right?
Yeah.
So like here's a fun, the human brain is really good at this thing called thin slicing, which like when you meet a person, that's your like gut interaction of like, if you're going to like that person, or like you have a gut feel about that
Yep.
person within like 3 seconds or
Yep.
7 seconds is what it
Yeah.
actually is. But you know what? If I asked you to do like 31 times 75, you'd be like, so there are just different types of human intelligence that, or there are just different types of
Well, no,
intelligence. And
computers are great for speed, and to your
right.
point, math or Wordle, right? Or words with friends, playing Scrabble or
Yeah.
chess. Yeah, it can look at all the different moves faster. But here's the thing: even in chess, and it took a long time for the computer to beat Kasparov because Kasparov had this thing, right, where he could intuit like
Right.
what the other person was going to do, and the computer can't do that. So look, I love computers. I love 'em, I use them all the time. But I just don't believe that we're gonna be fed Chat GPT script and accept it. I just
Mm,
don't think that's the way it's gonna work. I
yeah.
think, um, because again, the problem with all of that is it's gigo. It's garbage in, garbage out. If you're putting the wrong stuff in, bad stuff's gonna come out. And yes, it's funny when someone says, "Oh, write an essay on why Bitcoin's awesome in Donald Trump's voice," and "Oh, it's going to be huge." Okay, great. Anyone could have done that. My 7-year-old could have done that. Oh yeah, he says huge a lot. Great, cool. It came out of computer, but that isn't really that. I mean, it's interesting that they know Donald Trump says huge, but the rest of the words about Bitcoin weren't really unique or unusual. And
Yeah.
so it's fine.
Yeah. Let's sort of circle back to where we started here, and I know we've got to run. Um, you know, GDP looks like it's holding up. Your sort of perspective is that we're going to see negative prints in Q1 and Q2. Crypto price action has been quite good. We had kind of a it's been a little while since we've had a Bitcoin led rally, right? Which felt pretty good to watch. That I feel like that I haven't seen one of those since 2021, frankly. And but now we're almost starting to see like Aptos, which many people on this podcast probably won't know. It was kind of this like layer one, very heavily like VC invested type of, and that's been ripping. It's got like a $20 billion valuation or something like that, which is more than Zoom. So that to me makes me a little bit worried. But like, where do you sort of land on crypto price action? Because one, I sort of am in the camp that we've probably seen the bottom in terms of price. It seems like there are huge headwinds though, just in terms of like general business activity for the space. Where do you sort of see all
Yep.
that shaking
So
out?
look, the most recent move isn't crypto, it's the dollar.
Mm,
So since October 24th, the dollar has collapsed 10%. Why? Well, the powers that be met and they decided that it's the euro and yen's turn to be in
In
the
the hot
hot
seat.
seat, right? And they have to appreciate their currencies because look, everybody wants to devalue their currency. That's a beggar thy neighbor world. And particularly in a deglobalization world, you have to shrink your currency because you export. And when you look at China, for example, China used to be all about export from China. Now it's about selling to China, right? Everybody wants to sell cars, goods, clothes, handbags to the 700 million people in the middle class in China.
Mm.
So everybody needs a weak currency. And the dollar got a year worth of weak currency, and so from January last year to October, the dollar DXY relative to the yen and the euro, 18%.
Mm.
18%. Now, it's given more than half of that back in the last 10 weeks. I mean, it's been a straight down move. So Bitcoin didn't go up. Bitcoin priced in dollars went up because the dollar went down. And so I think the question for everyone is pivot or no pivot. So raising less is not a pivot. It's just not, right? Stopping raising is not a pivot. Cuts are a pivot. Now, I think it's very low likelihood there's going to be cuts. I mean, Jerome the Hawk says he's gotten to 5.5 on the short end. We'll see. Um, Everyone's convinced he's only doing 25 next week. We'll see.
Hmm.
I I think the continued pressure on him to raise less, and Ms. Lagarde is now in the hot seat. She's got to raise rates. She's 200 basis points behind. It's weird though, right? In that she started raising rates and European stocks went like this. I mean, straight up. Now, I get European bank stocks going up. They should because you're expanding the NIMs, but other stocks should have got whacked, but they didn't. They've actually rallied more than the US since October. So it's a long winded way of saying I think all eyes need to be on the Fed, but also the ECB and my favorite, you know, Haruhiko Kuroda-san, who I think is going to unleash, and he already did last week, in 4 hours. No, I'm sorry, 4 days, 4 days, 4 days, not 4 hours, 4 days. In 4 days, he completely reversed all of the global QT by doing
Yeah.
$32 billion of QE. 4 days, reversed the entire previous year of QT. So the dude is unleashing I call it the Kuroda tsunami. And that that is going to devalue the yen. And I think it could be an interesting year for Japanese equities. And Japanese bank stocks have gone totally ballistic. But I think others are going to have to follow that. So if we get back to a world of of big liquidity, China has increased stimulus. They're halfway back, and probably another half trillion this year. That'll be big. Chinese equities will rip if that happens. Um, Kuroda-san, I mean, here's the great thing. Remember when Kyle Bass said 100% debt to GDP, Japan's going to fold, can't survive this. They're at 226.
I know.
226.
I know.
And he bought 14% of the JGBs.
Wow. I didn't realize that.
14% last year. 14%. So Haruhiku, which I learned, if you look at his kanji name, two symbols. The first symbol translates to big, far, or flourish. So he is a big wave surfer. He is the big kahuna. And I think all eyes have to be on him and what Japan does. So
That I mean, look, they call that trade. That's the Widowmaker trade, right? Famously for such a long period of time. But I agree with you. I think, I mean, periodically, right? There's speculation that they're going to abandon their successful regime of yield curve control. There's also a changing of the guard, right? Corona
Yep.
is stepping down as head of the BOJ. So I agree. And then I also saw some, I don't want to, I didn't really get this confirmed because it came from a anonymous Twitter account, but that inflation was heating up in, this was
Yeah,
Tokyo
there has
specific
been
inflation.
a little bit. So
Right,
look,
so just
yeah,
a tiny bit, but that's the
yeah,
black swan thing, right? I mean, that's the
that
last
is.
duration anchor, right? Is the Bank of
Yep.
Japan and everything that's going on in Japan. So we'll see. I suppose we'll see.
We will see. As always,
I know
best
we got to go.
hour
Mark,
of the
best
week.
hour of my week, my friend. All right, I will see you here next week. Have a good
Same
one.
time, same bat time, same bat channel.
Exactly,
All
exactly.
right.
Cheers, my
See you, man.
friend.